Check out Treasury yields this morning. They have been higher. The 10-year right now is yielding 4.55. The 30-year is above 5%. It's at 5.03 right now, and that's the highest level we've seen since November of 2023. Let's talk a little bit more about the move in rates. Rick Santelli joins us from the CME. Rick, there are so many things that are swirling around this. We know about the Moody's downgrade. We know that that raises some concerns about things that we already knew were out there for the last decade and plus. What do you see with these moves in the Treasury market this morning?
Well, you know, part of me wants to look at the downgrade as something probably a bit more important than it is. And what I mean by that is, as we see our politicians in D.C. trying to figure out and push through the budget, I would hope that the Moody's message and some of the agita that the media expressed when it occurred will hit home. I would like to see a little fear on deficits. I would like to see the threshold of worrying about deficits raised a bit. But that's not the reality. That's what I wish. I think, Becky, the reality is that it really is putting things in line. I think even the ones in 2011 and 2023, you know who's the best rating agency in this day and age we live in? The markets, the big users, the end users, the purchasers of these securities. But I will point out that it is no surprise to see, as we try to tackle the budget and this particular president, how the press is looking at every little thing that occurs in a way that maybe is not normal in history, is also in a way a good thing, because as they discuss the budget, we've talked about this long before some of these rates moved up, that focusing on that is going to focus on debt and deficits. And that's what the story is, in my opinion. I know that there's a lot of anxiety about certain auctions, and I've expressed them. In the last auction, the 30-year auction that we had last week was kind of weak. Some of the bidding processes have changed, and some of the foreigners maybe were the weakest showing up at that auction in 5 years. However, some of the other bidders, called direct bidders, were some of the strongest bidders in 15 years. So the complexion of who's purchasing securities may be changing. I don't think the nearby issue is our ability to sell debt. I think the nearby issue is going to be the markets are going to raise the red flag because of the attention that we're being placed on debt and deficits, and that's exactly what's showing up right now in long-dated yields.
You always grade all of these auctions for the treasuries, for the notes. Today, I think, what is it, 3-month and 6-month that we're expecting today? I do know people are going to be watching that pretty closely. What have you seen over the last couple of Mondays when you see these auctions? What do you expect today?
Well, I think that the bill auctions, I worry about much less than some of the longer dated auctions, but it is something to pay attention to, because the Treasury, current Treasury, and even the past Treasury under Janet Yellen, they do find a propensity to try to do a lot of bills. And the reason is that there's this notion they're going to be able to tackle things and bring rates down. So why put paper out there at higher rates when you can do the bills and slosh around and eventually maybe peg it to lower rates? But the bill auctions, the demand does waver a bit. But all in all, don't see any issues on the bill auctions other than maybe size will have to be ramped up a bit.
What other auctions should we be paying attention to this week? What are you paying attention to?
You know, I think that, well, first of all, Wednesday we have a 20-year auction. 20-year, like 7 years, isn't going to garner you big information. I would continue to monitor the combined direct and indirect demand at auctions, especially the 10s and 30s, knowing that some of the paths to get these securities and the whole process is morphing a little bit. Some of the relationship between those entities that can directly intertwine with auctions versus indirectly through intermediaries gets a little blurry. But all in all, we had Treasury International Capital Flows data out last week, Becky, known as TIC data. And I just don't see that there's any huge changes out there, although as rates move up, what that's telling me is that the ante for this poker game of debt has gone up. When rates go up, it means investors pretty much are going to be demanding a little bit more to take the added risk that's put into the system when the U.S. is not only on a rising debt parameter, but the current administration isn't really making a positive difference there, at least based on the static measurements being done by many of the, like OMB. Once again, when we put forth budgets or any kind of tax changes, I prefer a more active versus static evaluation, but we're just not there yet. Dynamic scoring, maybe it would make a difference. Look at the Journal today, Becky. Here's what it said. It said, if we do nothing, we let the tax cuts expire, to be $2.7 trillion difference in the deficit. The problem is, if you let those expire, the loss of growth isn't counted. The numbers would be bigger than $2.7 trillion. So it's an apples to oranges comparison.